The Wall Street bells tolled. Stocks traded in the red. Stockbrokers ran amok. The employees of Lehmann Brothers walked with boxes in their hands. And the entire international economic order felt the ripple effects of the collapse of the American economy. Are we describing the great financial crisis of 2008? You're absolutely spot on. But what might have happened 15 years ago, and might seem like a relic of the past, might strike us any day in 2023. As we've highlighted before in our videos, an economic deja vu can potentially strike us all. Why do we say that? It's because the potential catalyst of the current economic crisis is none other than the housing sector. This might seem eerily coincidental, but the warning signs are there for all of us to see. Let's take a look at each of them one by one. They say lightning does not strike the same place twice. But the U.S. housing market seems primed to be a catalyst for another great financial crisis, but this time in 2023. As we mentioned several times before, inventory levels in the U.S. have been at the lowest we've seen, even lower than that during the period preceding the 2008 crisis. What could be the reason for that? The mortgage rates in the U.S., they're high. At the point of recording this video, the 30-year fixed mortgage rate stood at 7.18%. The last time the rates were so high was back in 2007, just before the crisis. That has resulted in fewer people applying for mortgage applications and deterred homeowners from putting their homes up for sale, may it be investors or individual homeowners. These are just two factors that have contributed to the low inventory in the market. But that's not all. The median prices of houses for sale has been pegged at $420,846. The last time the prices have been so astronomically high? Yeah, you guessed it, the period before the Great Financial Crisis. So, the alarm bells, they're not exaggerated. The housing sector is definitely exhibiting something eerily similar. Are we witnessing the inevitable before our eyes? Let's delve deeper into the topic. Before we continue, please like this video and subscribe to our channel, as it helps us a lot with the YouTube algorithm. Also, hit that bell icon to be notified when we drop new content. Let's revisit the price that we spoke about, $428,846. In real estate, a thumb rule to judge affordability is to multiply the average income of a household by 2.6. So, a household earning $100,000 a year would be able to afford a $260,000 home. The average household income in the U.S. was reportedly to be $74,580. So, unless someone is offering massive discounts, affordability seems to be a distant dream. Even if we concede the point that the median home sale price is not an accurate reflection, the reports coming from the ground are not so encouraging either. A report by The Guardian takes into account major metropolitan areas in the U.S. and spells out how unaffordable the current market is. Now that we know the variables in play, what's next? Can these different variables trigger the next housing crash? Our findings tell us that subprime loans were the financial instruments that led to foreclosures and the eventual crash of the housing market. In other words, loans that were given to borrowers with an unfavorable credit history led to massive defaults that collapsed the housing market. As we've discussed in prior videos, and in our earlier section, we talked about high mortgage rates and low mortgage applications. Does that not affect the profitability of lending firms? Absolutely. In times like these, and to keep their operations running, lending firms are coming up with loan structures specifically designed to help people get their dream homes. Zillow Home Loans, a lending firm based in Seattle, has rolled out a 1% down payment loan structure that stipulates that the borrower only needs to pay 1% of the down payment, and the company would match the other 2%. This would help push costs down and make homes more affordable. In a similar vein, Bank of America has gone one step further and rolled out a zero down payment loan program. It takes care of various costs associated with buying a home, essentially providing people with home equity seamlessly. Such loan programs give us an unpleasant reminder of the borrowing practices during the 2008 crisis. A burning question that everyone wants to know: what now? How and when will the economic crisis strike? Let's look into the economic crystal ball and try to predict what might happen. First, let's look at why an economic crash or a bubble burst is imminent, or even inevitable. The housing market right now is more or less closed, in a sense that fewer people are buying homes and even fewer are willing to put up their homes for sale. The prices are astronomically high, and in such a scenario, demand is muted, and so is the supply. Such a situation creates a paradox in which any small shock might shake the whole system to its core. A shock might come from the investor market. Investor markets run on borrowed funds, and if they feel like the prices have been stagnant for far too long, they may lower the prices and sell the homes for a discount. Figures suggest that the real estate investor home purchases fell a record 45% in the second quarter of 2023. So, evidence suggests investors are not keen on the market. In a market where there is low demand and low supply, the prices may remain stagnant, or may keep increasing, giving the illusion of a strong market. According to the data gathered by CoreLogic, investors own about 26% of all single-family homes in 2023. Even if 5 to 6% of those homes are sold by investors to minimize their losses, it could trigger a widespread sell-off. A different economic trigger might come from risky loan structures. Inflation remains high in the United States, and as has been reported widely, gas prices have been driving inflation. The current surge in core inflation defeats that argument. When the purchasing power of people is declining and a risky loan structure is giving people home equity, fears of defaults and home foreclosures do not seem to be a far-fetched reality. So what are the experts saying? Although the U.S. economy had been pegged to go into a recession, the reports are still a little gloomy. Ask Warren Buffett's Berkshire Hathaway, which has sold a significant amount of shares anticipating a stock market crash. In a similar vein, the famed Wall Street broker Michael Burry has also bet $1.6 billion in the form of put options contracts tied to the S&P 500 ETF Trust and Invesco QQQ Trust. The stage seems to be set for a deja vu of the 2008 crisis, but there are some counterpoints that suggest a different story. Do you remember the lending practices before the 2008 crisis? The creditworthiness of the borrowers was just glanced through, and background checks were not that extensive. It gave rise to a practice called liar loans. 15 years and some learnings later, the lending practices have improved. Background checks are extensive, and loans are not being granted to just about anyone. The risky loans that we spoke about contain certain conditionalities and are limited by the area of operation. It is stated that the construction activity never matched the pre-financial crisis levels. Builders are more cautious, and therefore the market has less of a chance of overflow of homes for sale, which can affect the price. When we take all of these factors into consideration, it might confuse us. Which way is the market going to go? Even though some experts agree that a crash similar to 2008 is unlikely, a market correction is definitely underway. The interplay of different variables that we looked at will decide where the market will go. In reality, however, the economic situation is decided largely by sentiment. If we take into account the law of a vital few, the interaction between one or two of these variables can trigger a widespread response. We would like to think that we have made our systems more resilient. But, as we all know, history has a way of repeating itself. All of the factors are pointing towards a repeat of the economic crisis of 2008. So, our economic crystal ball certainly is pointing more towards at least a price correction, if not a crash. As to when it might occur, that's anyone's guess. Our learnings illustrate that it is always best to remain cautious and vigilant, and have enough hedges against market risk. If you've been following our analysis on the U.S. housing market scenario, feel free to subscribe and give us a thumbs up by clicking on that like button. It allows the YouTube algorithm to push and grow our channel. If you're feeling extra generous, you can press the bell icon and never miss any of our uploads. Thank you, and we'll see you in the next video.